I feel a bit like you give me a slap, like you think you know, actually you don't know. Today, I have invited Thomas to the show just to discuss about the recent topic that he just wrote about, talking about the market is overvalued and then now it's time to take profits, right? So welcome, Thomas.
Hey, thanks for having me, Bunty. Glad to be here.
Yeah, so let's straight away jump to the questions, right? Now the PE is very high. I remember in your article you mentioned PE is 29, and then if we check the latest number, I think it's like 31 or 32. Even recently, everything is flying. For example, like Bitcoin is like, I don't know what, 82,000. The entire stock market looks very expensive. Thomas, how do you position your portfolio now? Do you really sell significant portions of your stock holding?
Yeah, I mean, the market has been very crazy recently in an upwards direction, right? And we are starting to see a lot of people posting their portfolio results hitting all-time high. You know, the meme stocks are all starting to come back. But even outside of the meme stock, even if I were to look at the traditional companies like Chipotle or Costco, right? These companies are trading at 56 PE multiple. And when I try and look forward for companies that are growing slower, I mean, they're strong company, no doubt, but companies that are growing significantly slower, and you know, it's much more difficult for a company like Costco to scale. I often struggle to think of what a reasonable return would be, even for this kind of very strong, very traditional company. And when it comes to investing, a cash position is not a goal, right? Meaning, like, I don't wake up one day and realize that, hey, I want to go 10% cash, for example. It's not so much, but it is more of an outcome of the process that I do, right? And the market certainly is trending more towards the overvalued range right now. And when I look at a lot of the companies that I have in my portfolio, some of them are certainly more overvalued, but I'm not going like 100% cash, because I think, like, you know, if I want to time the market in and out like this, it is not possible. But rather, the thought process behind this is, when I try and think ahead 3 to 4 years, do I have any big expenses coming in, right? And for me, because at this stage of my life, I'm doing a little bit of forward planning, and I do have that. And so when it comes to being able to stay, you know, very steady in the stock market, it requires me to take care of the short term. Because when I think of the long term, growing my wealth, it is a series of short terms I need to take care of. So I need to anchor myself such that any expenses that I need within the 3 to 4 years, you know, I want to set aside cash for that, right? I don't want to take it for granted that, you know, in the next few years, this cash amount will just magically happen, right? Because the last thing I want to do is to sell during periods like late 2022 or 2023, right, when the stock market is depressed. I don't want to disrupt my compounding. And it's interesting that you brought up the PE ratio that I mentioned in the article, right? Right now we are going at 29 PE ratio. So when we look at PE ratio, it is a little bit nuanced, right? Because we can't look at just, you know, it's at 29 or it's at, you know, or during COVID-19, I think it was at 60 or something, right? Because there are periods of time whereby the PE multiple is not exactly an apple-to-apple comparison. So if we were to look at the chart for the PE in 2020, for example, I think one of the comments was in June of 2020, you know, PE was actually very high. But the thing about the PE multiple back then, even though it was high, the earnings were temporarily suppressed because a lot of companies went into COVID lockdown. And when that happened, right, the earnings are temporarily depressed. But the market know that this is temporary phenomena, right? And so they didn't discount all these companies as much, which is why we see the PE being elevated. So it was more of the earnings being temporarily suppressed. But when you look at the earnings today, it is a completely different story, right? All the companies are trading at peak earnings level, right? A lot of them are trading at record margins. So when I look at even for Amazon or Google or Microsoft, even for Facebook, right, Meta, a lot of these companies are actually trading at record profitability right now. So the scenario today is very different from like just a few years back. So we are trading at record multiple and at record earnings. And when it comes to the stock market, there will definitely be times whereby there will be a reversion to mean, meaning like, you know, competitive forces will come in or some sort of forces that will bring the fundamentals down a little bit. In the long run, all these are going to be noise, right? But like I mentioned earlier, the long run is a series of short run. And you want to make sure, like, if you have any things that you need to take care of, your expenses, you want to make sure that you don't invest money that you need in the short run. I thought I watched a little bit of the video you sent me earlier, which is the video you did on the P multiple, which is a great chart, right? You were looking across 100 years. Another thing to take note of during that period, right, is because at the turn of the year 1990 to 2000, we start to see accounting change a little bit, which is why when I look at P multiple, I tend not to look look beyond the year 2000 and before, right? Because back then companies, they are all more asset heavy. Right now, they are more intangible asset heavy, right? Meaning that companies in the past, they used to own a lot of building, a lot of machineries, and these assets are used to drive their economic growth, right? That's how they get their earnings, through hard assets. And when we look at all these hard assets, right, they actually get to depreciate all this, which is why their earnings look elevated. But when it comes to looking at the tech companies of today, a lot of them, they don't get to depreciate all these expenses, which is why their earnings look more suppressed compared to all these more traditional companies. Which is why, like, when we look at the PE multiple in the more recent, like 2 decades, for example, a lot of people are saying when PE multiple above 20, it is overvalued. And now that is not true, right? Because the earnings, the quality of earnings for today's company is actually vastly different from the companies of the past. Especially when we look at indexes that captures the largest companies in America, we start to see a lot of these asset-like tech companies, right, who don't get to depreciate their expenses like the companies of the past. So like it is actually normal for PE multiples today to be bigger than PE multiple before 1990, for example. But if I were to look at just the PE multiple within the past 10 to 20 years, it is certainly more elevated today than in the past.
Thanks a lot for the explanations and additional context. But can you help me understand that you mentioned that you will be using the money. So you have a pool of assets for your investment. Do you really need to sell, let's say within 5 years just to fund your expenses, or do you actually have your income enough to support, meaning that those money in your portfolio is really meant for those longer terms, after 10 years?
Yeah, so I think you hit a great point there, because when it comes to making all this investing or personal finance decision, right, there's a bit of variation from people to people. And for my case, right, because I sort of left my job since 2020, I think. And so for me, whether there's income coming in or not, it is very uncertain. If it comes in, it comes in. If it doesn't come in, then that is fine also, right? So, and for me, most of my cash is parked into stocks. So I don't hold a lot of, or rather, I do hold 2 years worth of expenses in cash. But besides that, all my investable cash, I'm invested all the time. So even when I'm selling right now, it is not like, I sell and then I want to buy back afterwards. I'm selling and I'm parking all of them into short-term assets whereby I can liquidate immediately, right? Some of them in Singapore saving bonds, some of them in something else. But ultimately, this is strictly set aside to meet potential expenses in the future, right? Yep. If today I'm still having a job, for example, and I'm drawing a very fixed monthly income, I probably would not be selling, because it is very predictable. And again, it depends on what job you are. If you are in sales, etc., it is a bit more lumpy, then I may be a bit more conservative. But if I'm in the public sector whereby the paycheck comes very steadily, then I might not have to be as conservative as this, right? But because of the nature of what I'm doing, because I left my job many years back, and so I'm always leaning more towards asset protection rather than be so aggressive to try and capture whatever. And I'm a strong believer that if I were to take care of my downside, the upside naturally will take care of itself.
Yeah. I think that's context is very important, right? Because say, for example, let's say if I'm a retiree, I really need the money. So for sure, even regardless of the PE, I would still say, okay, as long as the price isn't that bad, I would just prefer to keep some in cash so that I don't have to worry about the market prices in, let's say, 1 year or 2 years during short period of time, right? So in your case, really, you just want to have that additional buffer so that you have more predictability in terms of the amount that you need over next few years now. So can you give a bit more details? Because I don't know the full details, how much you actually pare down, right? Say, for example, before this, market run out, right? What was this agak-agak your equity allocations versus now after you're taking some profits? Is that a big adjustment, 5-10%, or is it a lot more?
I sold off about 10% of my portfolio, but yeah, so I thought of, and there was another interesting thing you mentioned, especially for the retirees. So I think a lot of investors, they do like something dividend stocks or whatever. But for me, I'm always thinking about maximizing my total shareholder returns, which means it is both share price increase and also dividend. And when I do that, most of the companies I'm invested in do not actually pay out dividends. Maybe 20 to 30% payout dividends. So that means I must be willing to sell when I want to consume, right? Ultimately, I only want to sell my stocks if I want to meet expenses and then not and whatnot. Yeah. So if my investing philosophy leans towards not just passive income that's coming in, it means that when the market is in my favor, right? I have to be willing to sell if I want to meet expenses. Yeah. On the other side of the coin, right? There'll be people who prefer dividends. But the thing about dividends is it is actually almost like selling, because when you buy into a stock of a company, you're actually having ownership of these businesses. And when they issue dividends to you, they're actually liquidating part of your ownership back to you, right? And that is the cash on their balance sheet, right? And so for me, I prefer a more active approach than to, let the company decide when to quote unquote sell for me. Yeah. So that's fine with me. Yeah, but it's about 10%.
Sounds good. So can I get into more details? Like when you say, I think that if we just judge based on current sentiment, right? I think it's not hard to agree that yes, now it's a bit bullish, especially after the US presidential elections. Market just ran up, right? Like aside from PE, is there any other things that you are paying attention to gauge, like, is it like overvalued now? Do you just looking at one or two indicators or more?
No, I think like when I use the PE in the article, right, it's because it is intuitive to understand, and it covers a broad spectrum of the companies. When it comes to the individual portfolio, I mean my own portfolio, right, the individual companies, not all of them are overvalued, or or maybe some of them are fair valued. So it is very much a bottom up approach rather than I look at some big indicators and then I make my decision. Again, like the result of cash, right, is more of an outcome, not a goal whereby I look at this, then broad market indicator, then I want to sell. Yeah, so it's all I have about 20 stocks, so all of them are about case by case basis, and then decide which one I want to trim more, which one I want to trim less. Some of them I don't trim at all, right, because I feel like they're not as overvalued.
So the PE is more like just set the scene rather than you are using this as an indicator to move in and out now. Okay, that's not your approach, right?
Yeah, it's a good no. It's not my approach. I mean, my approach is still I look at every individual stock. Like for example, Costco is clearly very pricey at the moment. And then there are other things like maybe Amazon not as pricey, right? Then I'll do the adjustment accordingly.
Can you share a bit more? Like, let's say since you started investing, right? Have you made this kind of pivot? Say for example, pivot into like allocating a lot more assets into equities, or get out of assets? Do you have this kind of like different period do this kind of things? Can you share a bit more?
Yeah, so I mean, because 2020 was when I just quit my job and just live off my savings and investments, right? Up till 2020, I've actually never sold, I like go into cash or anything like that, because there was always a steady income coming in. So I've actually never done that. This is the first time I'm actually doing it. Yeah, I mean, just because of life planning for the future. But other than that, the very aggressive period whereby I was buying was 2022, I guess. Yeah, that's when I really like, even my CPF is I just go in. But I mean, I don't leverage. Strictly no leverage. And another thing that so I mean, when it comes to investing, there's a few rules I abide by, right? So like I always have 2 years of emergency fund. Not everybody need to be so conservative, because I assume most people still have a very stable income coming in. Then I also make sure all my insurances are taken care of. No money that I need for the next 3 to 4 years. So basically that. Yeah, but other than that, I usually don't sell. I usually don't sell. Even if I were to sell something, I will move it into another stock immediately. I don't hold cash that much.
Yeah, there are some that maybe not that cheap, but still attractive enough for you to allocate in.
Yeah, that's
it's more
definitely
like
opportunity. I think you're exactly right. There's if you look hard enough, there's always opportunities out there. Like I mean, even now I can see some stocks that are very reasonably valued. I mean, there are some that are overvalued. There are some that are, I mean, we are not Warren Buffett, right? Our investment don't need to be like a few $1 billion for it to make sense. So we are not hunting whales. So actually, the investment universe is a lot wider for small prawn like us. so I mean, there's definitely something to look at for sure all the time.
I missed the period during 2022. That was a period where very depressed, market looks red, especially my portfolio. I think that was the first time when my portfolio hit like a like I would consider sizable, and that's experience that drawdown. Then after that, now can look at the portfolio happy, but it's harder to buy at attractive level at current market environment.
It was definitely a tough period. And I think like what helped me tide through that period was more of these rules whereby, it protected my daily life, right? It doesn't affect me because I got quite a bit of cash for emergency and all that whatnot. So it doesn't affect me. But I do know some investors who are leveraged or who use leaps options, right? And the time is ticking down. And that, I think that really stressed them out into making subpar decisions, because like ultimately when you're investing, right, you are compensated for the quality of your decisions. And which is why I set all these rules, because I don't want my quality of decisions to be compromised at all, right? In all situations, I should be able to make very rational call. But I think if you have your back up against the wall, it could be through leverage, it could be through, you don't have emergency fund and suddenly you need the cash, or you invest cash you're not supposed to because you need it in the next 2 to 3 years. Then I think that makes people do stupid things.
Yeah. I think definitely the safety net is very important. I think typically, let's say if you already have your place to stay, and then you have your CPF to take care, like at least you have some minimum. The rest is more like good to have, so you can invest in a not so stressful manner. Okay, so I want to just check with you, because right now, right, PE is high, definitely, we can see that. But that's also because sentiment is good. For example, like everyone talk about Trump, right? The pro-growth environment. He's talking about like cutting tax, deregulations, and arguably all these things, right? I mean, not to say we are doing, like bottoms-up analysis, but still from a macro level, deregulations, these are still the things that help with the stock market. I mean, just helping them in terms of fundamentals, not just like, okay, the PE should be higher, not like that, right? It will help earnings, tax is lower, right? It's very straightforward direction. And then the other thing is that if indeed it's true that all this pro-growth policy will lead to higher inflations, right? Then I also think that if you put your money into, let's say like bonds, right? Whether it's SSB or treasuries, you will just be inflated away, right? So that actually is my argument to say that actually we should all just stay invested in equities. So just want to hear your comment on this regarding the policy. How would it affect your decisions when it comes to investing? Do you incorporate those?
Yeah, this is an interesting one, because I think there's a lot of people trying to speculate with very high confidence, like, oh, if Trump happens, then this will happen. But the truth is, when it comes to the economy or the stock market, there's always multiple factors that are running at the same time, right? And so to say that because A happened, then B must happen is usually not very accurate, right? And there's a good example that my friend Serging from the Compounder Fund, he recently shared, right? He was sharing this old article with me by Morgan Housel. And so during the 1992 election, for example, when Bill Clinton first got elected, and he's one of his mandate was to actually reform the US healthcare system, right? And all the economists and all the forecasters back then says that it's going to be disastrous for pharmaceutical stocks, right? Very similar to what people are saying about JFK is going to do to all the, the unhealthy food companies. But the truth is, pharmaceutical companies actually did extremely well when Clinton was president, right? And then so like one of the examples is that Pfizer actually rose almost 800% during his presidency. Johnson & Johnson popped about 400%, right? And all the other pharmaceutical companies actually did very well during Bill Clinton period. And it's not just that. The other one is George Bush, right? And a lot of people are saying that George Bush, because of his tax changes, is going to help banks, brokers, and investment firms. But when we look at the end of George Bush presidency, right, the bank index actually dropped almost 80%. Right, and when we look at every single one of them, even Obama, right, many predicted that it would be a big win for green energy, solar and wind. But the truth is, the iShares Clean Energy ETF was down more than 50%, right? And every single prediction that a lot of these very, very clever people look into, like Morgan Housel is one of them, and none of these predictions actually came true. So when we look at one factor, they have this set of policy, and we are trying to imagine what the economy or the stock market will look like 4 years later. Almost none of them actually came true, right? So it's very difficult for me to make investment based on, because A happened, then B must happen, right? The economy is very adaptable, and there are always multiple things going at the same time, right? Just because A happened, right? C and D might come in to interrupt certain dynamics of the wheel, and the expectation or the outcome may not be eventually what we imagine, right? So I always want to, it always goes back, for me personally, it always goes back to investing in great companies that will do well regardless of who is president. When I invest this way, I think I sleep better at night. rather than, you know, I'm relying on certain things happening when the world is so dynamic. Yeah, so I'm not betting any money on because right now he said this during his political campaign, then, you know, this set of outcome must happen.
I think that's a very good response. I feel a bit like you give me a slap. Like, you think you know, you actually it's not. You think you know, actually you don't know. I think that's the takeaway from this. So actually, my last question.
It's not really a slap, but then but I mean, I'm trying very hard to think about what will happen also. But the truth is, when I look at historical, whatever people are saying will happen, it usually doesn't happen. Doesn't mean that this time round it won't happen. It may finally for this time round, but the truth is, it's very hard to bet serious money on it.
It's very hard to predict. I still remember, let's say, like monetary policy, right? During those periods, they do QE, everyone talk about inflations, then no inflations comes. Then the recent COVID, all the measures, right? People are talking about, okay, inflation should be okay. Then inflation whack us big, right? So it seems like all these things, right? It's like people thought that they know, but actually we get it wrong too often and make it unreliable to help us guide our investment decisions. So
like I mean, this point is interesting because like for the past 2 years I've been fighting with people on Twitter, right? For those of you who don't know, I'm very active on Twitter, right? And a lot of times, like I was showing people data that when interest rate rise, historically actually stock market actually rose. It is not like the theoretical concept when interest rate rise, you raise your discount rate and then asset prices must come down. Again, the economy has multiple things moving at the same time. And the truth is, when the Fed started raising interest rate near October or November in 2022, the stock market continued to make all-time high after he raised interest rate, right? But I frequently get into like this kind of arguments on Twitter.
My friend Kelvin learn investing used to joke, the moment you start the argument, you are wrong already. Made them wrong. But
it's a lose-lose thing.
Lose things. But that's Twitter X. Actually, I want to ask you, like the other person that just recently, you know, like liquidated the portfolio, similar to you, right, is Warren Buffett. So his one is like his cash stash is much larger than yours and mine combined. So he's like what 300 plus billion in cash, right? So I don't think he gave a lot of explanations because I don't recall any, let's say, like interview post that actions, right? So that one people find out from the 10Q, right? What's your guess or what's your take on why he's liquidating such a big percentage? Like even if you value as a percentage of his overall portfolio, still quite sizable, right? And we're talking about 300 plus billion, big sum of amount, right? Any thoughts on that?
So when it comes to looking at Warren Buffett's cash position, right, we always have to read beneath the line, right? Because like I mean, I attended the last AGM last year, and he was saying like, you know, Apple will always be a core position. Maybe he will stop selling after this round, you know, and all that kind of stuff. But the truth is, when it comes to his cash position, we must always measure it against his insurance arm. And the truth is, when I'm measuring against his insurance liabilities, it is also at an all-time high. He has been buying back Berkshire Hathaway stock. I mean, this is a separate issue. It doesn't mean that the overall market is expensive just because he stopped buying Berkshire Hathaway. It just means that Berkshire Hathaway is more expensive than usual. And I think when it comes to him selling a lot of Apple shares and the banking shares, I think is more from a systematic risk aspect, because he's one of the best banking investor. Actually, he is the best banking investor in the entire world. And since the bank, the Silicon Valley Bank that went collapsed last year, he's been liquidating most of his banking stocks because he's worried about the risk there. As for Apple stock, it is an interesting one because when we read what he used to do, he has actually never sold a share of American Express. He has actually never sold a share of Coca-Cola, no matter how overvalued they became in the past history. Even during the dot-com bubble, when even Coca-Cola became extremely expensive, he did not sell them. I mean, this is just me guessing. I think one thing is definitely Apple is leaning more towards the overvalued range. The second thing is he is guessing that taxes are going to rise going forward because the US government is spending at an unsustainable rate. So I mean, he's taking off some profits now and paying the taxes so that he don't have to incur higher taxes in the future. And the third thing is it might possibly be his take that Apple is not as robust an investment as Coca-Cola, for example. Maybe it's just the nature of the risk when it comes to being a tech company that's doing business all around the world. But overall, this has been a massive winner for him, right? When he bought, if you remove the cash of Apple back when he bought in 2016, I think the PE multiple was only 8.8 times or something.
Yep.
Similar to Facebook in 2022 or 2023. Yeah, so I mean, occasionally massive winners like this will come, and right, he held on from single digit P all the way until now 34 times P, and the company essentially is not growing. Right, there are most of the EPS growth is driven by share buybacks, and I mean, if I'm Warren Buffett, I'll feel frustrated with Apple buying back shares at today's valuation. I'll feel like I'm tearing my hair out, because share buyback should only be done when the company is undervalued. Not when the company is trading at such a expensive multiple. And Apple traditionally has been underinvesting in AI, right? They don't really have a very, very strong AI strategy. Not like Meta, not like Alphabet, certainly not like Amazon or Microsoft as well. That sort of chip off at some of the companies' mode, because right, when we look at the Apple sales for this year, it is quite a flop compared to what they used to achieve in the past. And we start to see a lot of phones close the gap. Yeah, so I think it's a multitude of these reasons. One is definitely Apple is more overvalued today. Two, possibly because of taxes. And then three is I think Apple might not be as strong as a company as his more anchor positions, like it could be American Express or it could be Coca-Cola.
But I'm just thinking that the last point, right, talking about like whether how resilient is the business, right? Because we just have to look around our friends, those who are using Apple, are they still continue when they upgrading phones? Do they switch to Android or not? I think that's something that we can observe, right? I'm comparing that versus, let's say, our friends who used to, not every day, like it's like often drink soft drinks, Coca-Cola. Now because of, health concerns, I think slowly I've seen people pivoted away from, like having sugary drinks, and people also tend to know like the downsides of having too much sugar, glucose, right? So I do think actually, if I ask me between sugar versus Apple, I would say Apple might be more resilient as compared to Coca-Cola. That's my personal view, not like I did a lot of research to compare.
So the branding of Coca-Cola as a stock is a little bit misleading that way, because definitely right. I don't drink sugar drinks at all, and I think this trend is a mega trend. More and more people are going to stop drinking sugary drinks. And I mean, if I'm Warren Buffett, I would be worried if Coca-Cola is still selling sugary drinks. But the thing with Coca-Cola is since the past few years, it's not just Coke Zero, right? That gives the healthier option. But when we look in Singapore, like Ayakata and all that kind of stuff, they're all owned by Coca-Cola. Right? They're selling oolong without sugar. They're selling green tea without sugar. They're selling all sort of sugar-free drinks that are on the healthier side. So they actually have diversified their portfolio quite a bit over there. Yeah, so I mean, so this company is they do have a very diversified brand, rather than just the traditional sugary option.
So it looks like I need to do more research on Coca-Cola. If not, it's like something that's clouded my view. I thought that it's not to say everything is Coca-Cola. It's more like they are serving all this, and when you are making a business selling stuff, right, you want to sell things that people want to buy. And usually when people go out having a nice meal with friends, they will tend to drink sugary drinks, right? Because it tastes nice, right? I mean, it's either that or drink alcohol drinks.
It's a good point. Like when you look at Apple to see whether there'll be definitely 1 or 2 years whereby they have down years, but ultimately for the mode for Apple is device, is people starting to switch device and all that whatnot. Right now, not yet. We only see that they're not upgrading this cycle. Right, this cycle they're not upgrading because the improvement is not as big as people think. But I mean, if people are not switching out yet, this company is. It could still make a very, very strong comeback. They are not weak at all, by all means, not weak at all. It's just that this year they haven't been executing as well as in the past years.
Closing questions. What's the plan forward? Do you wait for PE come down, then buy back, or really just steer around these kind of allocations and just call it like that's the plan for 2025? What's your plan?
I mean, the cash that I have now is really to set aside to meet the expenses. But as and when if I have income coming in and there are opportunities out there, I will still continue to invest. It's always a bottom-up approach rather than today I want to time the market and I want to have this amount in cash. Not so much, but it's more like what's the opportunity set given to me of all these individual stocks, and if there are good opportunities and if there's cash coming in that I can invest, then I'll be very happy to invest them.
Okay, sounds good. That's a good closing. Thank you so much for coming to the show here, sharing your view. It's not just like short articles. Sometimes we don't get enough context. Now listening to your explanation, questions, I feel like I understand more on your thinking process. And thanks a lot for, like all this sharing, including those on X and Twitter, including those debates. Sometimes I think those are good for learning as well. Thank you so much.
Hey, no problem. Thanks for having me, man. Had a great time chatting with you.
Yeah, thank you.